Florida is sinking, literally and financially. That's not hyperbole. In 2025, the Sunshine State is facing a brutal test. Hurricanes, tropical storms, flooding, nature is pushing. Real estate values are bending under the pressure. And for homeowners, investors, and dreamers, the question is no longer if Florida will be reshaped, it's how badly and for whom. Let's start with storms, because storms are the writing on the wall. The 2025 Atlantic hurricane season has already delivered powerful reminders that Florida sits on the front lines. The National Oceanic and Atmospheric Administration projected above normal activity this year, with 13 to 18 named storms expected. The seas are warm, the atmosphere is primed. One of the headline makers, Hurricane Erin, which roared across the Atlantic as a Category 5. While its core didn't strike Florida directly, its influence rippled across the eastern seaboard, feeding moisture into rain systems and creating dangerous surf alerts along Florida's coast. Storms of Erin's magnitude remind us how closely Florida is tied to the Atlantic, even if the eye never hits land. And in mid-July, Florida and the Gulf Coast were soaked by a flooding event that doesn't often get front-page attention: the July 2025 Gulf Coast floods. A tropical disturbance formed off Florida's Atlantic coast, pushed inland, then roared across the state and into the Panhandle. Some locations recorded massive rainfall, deluges that flooded streets, knocked out power, and forced emergency responses. Homes were inundated, basements flooded, roads closed. Now in October, forecasters are watching two new areas of potential tropical development. One is near Florida and the Gulf, another in the Atlantic. Models show slow development, but even a weak system stalled over land could dump 3 to 5 inches or more of rain across the peninsula. In Florida, that's enough to trigger flash flooding, swamp drainage systems, and overwhelm low-lying coastal zones. Here's what all this means. The storm risk isn't theoretical, it's daily. Every hurricane or tropical system adds pressure to Florida's infrastructure, insurance system, and home values. Homeowners in beachside towns now must ask, will my house survive not just a storm, but the financial hit that comes after? To understand the stakes, look back to 2024. Hurricane Helene made landfall in Florida's Big Bend as a Category 4, pushing a historic storm surge, flooding inland and causing billions in damage. Many communities are still in recovery mode. The scars are visible in battered roofs, washed out roads, and in the uneasy questions over whether to rebuild or retreat. Research done by scholars looking at Helene highlights a sobering insight. Counties with high income and low population density tended to rebound better. Meanwhile, densely populated, lower income communities with social vulnerability suffered disproportionately. The ability to recover isn't uniform, it's deeply unequal. And even projecting forward, advanced modeling shows that storm surge risk along Florida's coast is intensifying. As sea levels creep upward, a 100-year surge event becomes more frequent. In essence, a storm that might have been a freak event becomes part of the new normal. Some models predict a 50% increase in people at risk in coastal zones by the end of the century. Let me pause and bring this back to real estate. You don't just lose a home in a hurricane. You lose insurance eligibility, you lose buyer trust, and sometimes you lose the ability to rebuild under stricter building codes. All of those are financial hits layered atop the physical damage. Now pair that with what's happening in the Florida real estate market. 2025 is showing real signs of shift. According to state realtors, July's closed sales for single-family homes dropped about 2.8% compared to a year ago. Meanwhile, condos and townhomes took a steeper hit, down nearly 11.8%. The median single-family price slipped about 1.7%. Inventory for condos is nearly double that of single-family in months of supply. The market is softening. In Sarasota and Manatee counties, data shows cooling signs. Inventory is higher than last year, and while properties are still selling, price growth is losing steam. Buyers are becoming more cautious, walking away from deals that once seemed like bargains. And Miami is under a microscope. Some global analysts just ranked it as the most vulnerable real estate bubble in the world. Why? Because prices are high. The ratio of prices to rent is stretched. Insurance and ownership costs are rising, and buyer demand is weakening in some segments. Even luxury is not totally immune.
If storms are the weather narrative, real estate is the economic narrative. And in Florida, That narrative is cleaving in two. Let me start with the coastal luxury markets, the places like Naples, Palm Beach, Miami's waterfront enclaves. These are still the crown jewels. Ultra-high-end buyers don't worry about 30-year mortgage rates. They have liquidity, access, and patience. They care about location, views, tax benefits, prestige. So even as middle-class buyers are pushed out, wealth flows toward these premium enclaves. Developers are still building high-end towers, custom mansions, resort-style condominiums, frequently marketed to out-of-state or international buyers. Flagship luxury continues to carry weight. What's changed is the lower rung, the entry-level and middle-tier markets. Those are where the cracks are showing. In Miami-Dade, Broward, and Palm Beach counties, residential sales volume recently slipped month after month. Entry-level homes under $500,000 have nearly vanished in many markets. The inventory of starter homes has collapsed as prices leap upward, making that next rung up often unreachable for many. What you see is a market where luxury remains, but the middle is being squeezed out. Take Tampa Bay. It once ranked among the hottest housing markets. Now it's dropped dramatically in Zillow's rankings, falling 19 spots. That signals a deceleration in demand relative to supply. Orlando isn't immune either. Inventory is swelling and many buyers are stepping back. In places like Cape Coral, infamous now, the downturn has been steep. Homes that surged during the pandemic are now discounting. Many owners find themselves underwater. Builders have pulled back. The speculative buyers are mostly gone. What remains are locals, retirees, or people willing to gamble on a recovery. But without strong job growth or migration continuing at scale, parts of Cape Coral may never return to those frothy highs. Meanwhile, inland and more affordable cities like Ocala are quietly gaining attention. Ocala is being highlighted as one of the most affordable in Florida. With a median home price well below the coastal norm, it offers value. For people priced out of coastal zones, moving inland has become a strategy. That shift softens pressure on beaches, but raises questions about infrastructure, commuting, and long-term growth. Luxury enclaves still command headlines: mega mansions, record homes, ultra-exclusive compounds. In Miami, the median home price for luxury homes is pushing past 7 figures regularly. Some estates list for $50 million or more. But those headline deals mask a deeper trend: fewer buyers for mid-tier homes, increased price cuts, and homes sitting unsold longer. Condos are another fracture line. After laws passed post-Surfside, many aging condo buildings now require massive repairs. In some cases, buyers and lenders balk at properties with looming repair bills, driving values down. In coastal cities dense with older towers, condos once seen as retirement staples are now risk zones. Many are being sold off at discounts or left vacant as owners walk away. The repair burden plus rising insurance costs is making condos a painful gamble in many communities. Look also at financing and interest rate behavior. The lock-in effect is strong. Many homeowners who locked in ultra-low rates in earlier years are refusing to move or refinance. That constrains supply. In coastal luxury markets, that matters less. Many buyers pay cash or with minimal financing. But in middle markets, that gap starves first-time buyers of opportunities. Investment flows are also bifurcating. Institutional investors and high-net-worth buyers are still targeting luxury beachfront product, trophy properties, or land parcels in resilient zones. They see opportunity in scarcity, tax benefits, and potential appreciation. On the flip side, speculative and small-scale investors, the ones who fueled the mid-market boom, are retreating or pausing. That withdrawal compounds weakness in those layers. In summary, in Florida real estate today, luxury is being shielded. Middle and lower segments are under pressure. Coastal towers and beachfront mansions may still fare well, with caveats, but broad swaths of neighborhoods in the middle are seeing stagnation, discounting, and uncertainty. In this final act, let's project forward. Where does Florida's housing market go from here, and how do you position yourself? First, consider risk thresholds. Coastal property values will increasingly be evaluated not only for aesthetic appeal, but for climate resilience. How high is your elevation? Are there mangroves or wetlands between you and the sea? Is your property behind seawalls or flood control infrastructure? Researchers now estimate that natural buffers like mangroves reduce storm surge losses significantly, in some Florida counties by tens of millions per year. Homes inland of these buffers fare much better than those directly exposed. Then, insurance. It's already a heartbreak. In many areas, homeowner premiums have soared. In some zip codes, insurers are refusing new policies. The National Flood Insurance Program is under constant legislative threat. If it lapses or becomes unaffordable, many transactions would collapse because mortgages require flood coverage. Even if insurers survive, expect stricter underwriting, higher deductibles, and reduced coverage in high-risk zones. Next, infrastructure and adaptation investment. Some cities are doubling down. Miami is raising roads, installing pump systems, retrofitting drainage. Others lag. The places that commit to resilience will likely retain more value. The places that don't may slip into decline. A future buyer will look at the municipality as much as the home. Interest rates will also play a gatekeeper role. If rates come down, buyer demand returns, especially in mid-tier markets. If rates stay stubbornly high, the upper markets may limp along, but the middle and lower rungs will struggle. In this scenario, we could see 5 to 10% declines in weaker markets. Migration is another wildcard. Florida still sees people leaving high-tax states, but if that flow slows or reverses, pressure mounts. The luxury market may sustain itself, but mass demand will falter. Let me map out 3 broad scenarios. Scenario 1, selective stabilization. Some coastal corridors with strong resilience plans, good elevation, infrastructure investment, slow further decline and stabilize. Mid and inland markets recover gradually. Luxury remains premium. Values inch upward over time. Scenario 2, soft contraction, long recovery. Rates stay high, insurance burdens intensify. Condos suffer heavily, coastal values dip modestly, 5 to 15%. Many middle markets stagnate. Recovery is slow, and speculative swings are muted. The boom era is officially over. Scenario 3, sharp realignment. Climate impacts intensify, flood and insurance crises escalate, demand collapses in vulnerable zones. Many coastal homes become semi-uninsurable or unsellable. The housing map redraws. Only resilient inland areas and premium enclaves hold value. Risk becomes central in valuation, not just location and amenities. So how do you prepare? Do the math. Run stress tests. What if your home loses 20% value? What if insurance doubles? Check risk layers, flood maps, elevation, seawalls, local mitigation plans. Target resilience. Prefer locations with elevation, natural buffer zones, and adaptive infrastructure. Manage leverage. Avoid highly leveraged purchases in uncertain zones. Long-term hold. Shorter flips are riskier. Homes bought for long-term may absorb shocks better. Diversification. Coastal real estate can be part of a portfolio, not the whole bet. In the end, Florida is changing. The storms are forcing a reckoning. Real estate is no longer just about views and sun. It's about survival, adaptation, and foresight. Some places will flourish, others will fade, and those that anticipate this shift rather than deny it will come out ahead.